While most investors were watching tech stocks in 2025, something extraordinary happened in the precious metals market that has wealthy investors paying very close attention. As we head into 2026, I'm talking about gold surging 60% and silver nearly doubling in value. But here's what's more interesting. It's not just about the gains. It's about what the wealthy are doing differently with their allocations, and why central banks are buying gold at record levels they haven't seen in decades. In this video, we're going to break down exactly how much gold and silver wealthy investors are holding, what the research says about optimal allocation, and most importantly, what this means for 2026. But before we dive in, a quick reminder. This is purely educational content. I'm not a financial advisor, and nothing in this video should be taken as investment advice. Always consult with qualified professionals before making any financial decisions. Let's start with where we are right now. As of December 2025, gold is trading above $4,000 per ounce, reaching all-time highs. Silver broke through $60 per ounce, surpassing its 1980 record. These aren't small moves. Gold is up approximately 60% year to date, while silver has posted gains of around 99%. But here's what makes this different from previous rallies. It's not being driven by retail investors panic buying. Instead, we're seeing a fundamental shift in how institutional investors, central banks, and high net worth individuals view precious metals in their portfolios. So let us answer the big question. How much gold and silver are wealthy investors actually holding? According to the 2025 High Net Worth Asset Allocation Study by Long Angle, which surveyed investors with significant wealth, here's what we found. The average high net worth portfolio includes approximately 5% allocated to hard assets, which includes gold, precious metals, and collectibles. Now, 5% might not sound like much, but when you're talking about multi-million-dollar portfolios, that's substantial. For someone with a $10 million portfolio, that's $500,000 in precious metals and hard assets. But here's where it gets interesting. This 5% figure is actually on the conservative side of what financial experts recommend. And there's a reason for that. Many wealthy investors view precious metals not as a growth play, but as wealth insurance. When we look at what financial experts and major investment firms recommend, we see a clear consensus emerging. Let me break down what the research shows. Studies from institutions like the World Gold Council, major investment banks overseeing trillions in assets, and portfolio managers consistently recommend precious metals allocation between 5% and 25% of a diversified portfolio, with most settling on 10 to 15% as optimal. Let me give you some specific examples. Sprott Asset Management suggests a 10 out of 15% allocation to gold and gold-related equities. They published detailed research showing this range provides optimal diversification benefits without overconcentrating in a single asset class. For high net worth individuals and family offices specifically, research by Clement and Longchamp recommends an allocation range of 5 to 10% by weight to gold in an equity portfolio. Some experts who are particularly concerned about financial system risks suggest even higher allocations. Egan van Greyerts, a board member of Goldbroker and recognized as one of the world's foremost gold investment experts, notes that some investors who are really concerned about the financial system have 60-100% in gold and silver, though he acknowledges that having even 10% ensures portfolio safety for most investors. So why such a wide range? The allocation depends on several key factors. First, your age and investment timeline. Younger investors in their 30s might allocate 5 to 7% since they have time to recover from market downturns and can focus more on growth assets. Middle-aged investors in their 40s and 50s typically go with 10-15% as they balance growth and protection. Those approaching or in retirement often increase allocation to 15-20% or more, prioritizing capital preservation. Second, your risk tolerance. Conservative investors lean toward the higher end of the range. Aggressive investors might be comfortable with less, focusing more on growth assets, but even aggressive investors typically maintain at least 5 to 10% for diversification. Third, your overall financial situation. Someone with significant real estate holdings might allocate less to precious metals since they already have tangible assets. Someone heavily invested in stocks might want more allocation to metals as a hedge. Let's dive deeper into why this 5 to 15% range has become the standard recommendation among financial professionals. This isn't just arbitrary, it's based on decades of portfolio analysis and something called modern portfolio theory. Here's how it works. Gold and silver have what's called low correlation to traditional assets like stocks and bonds. Over a 30-year period from 1994 to 2024, gold showed very low correlation to U.S. equities. This means when stocks go down, gold doesn't necessarily follow, and often moves in the opposite direction. During the 7 major crisis periods since 2007, including the 2008 financial crisis and the 2020 pandemic, Gold bullion returned an average of 16.94% compared to negative 7.24% for the S&P 500 Total Return Index. That's portfolio protection in action. Think of precious metals allocation like insurance. You pay your car insurance premium every month, right? You're not hoping to use it, but you're protected if something happens. Similarly, allocating 10-15% to precious metals is like buying insurance for your wealth. In good economic times, it might underperform stocks. But during financial crises, currency devaluation, or major geopolitical events, it can save your portfolio. The key is that this insurance also has the potential to appreciate. Unlike car insurance, where the premium is gone, gold and silver are tangible assets that maintain intrinsic value and can increase in worth. Let me give you concrete examples of what this looks like at different wealth levels. For someone with $100,000 in investable assets, 10% allocation knocks $10,000 in precious metals. This might be split, $7,000 in gold, $3,000 in silver, or following expert recommendations, 70-30 or 60-40 gold to silver ratio. For someone with $500,000, 15% allocation almost costs $75,000 in precious metals. Split example, $50,000 gold, $25,000 silver. This provides substantial protection while maintaining growth potential in other assets. For someone with $2 million 10% allocation, $200,000 in precious metals. This level might include physical bullion, gold IRAs, and mining stocks. Diversification within the precious metals allocation becomes important. Here's a crucial distinction that many people miss. When experts talk about allocation percentages, they're referring to investable assets, not your total net worth. As Jim Rickards, author of Currency Wars, explains, you should exclude your home equity, business equity, and other liquid or intangible assets that constitute your livelihood. So if you have a home worth $500,000 but you live in it, that doesn't count toward the calculation. Your investable assets are liquid assets you could potentially invest: savings, retirement accounts, investment portfolios. Now let's talk about something that has wealthy investors particularly excited about silver right now: the gold-silver ratio. As of late 2025, the gold-silver ratio is sitting around 80:1. This means 1 ounce of gold is worth 80 ounces of silver, but here's why this matters. Historically, this ratio has averaged around 60.1 to 70.1. Marcus Davidson, chief strategist at Precious Metal Analytics, notes that the current ratio sitting at around 80.1 suggests silver is dramatically undervalued compared to its historical average. This disparity signals significant upside potential for silver investors. Let me put this in perspective. If silver were to return to just its historical average ratio of 70.1 and gold stays at $4,000, silver would need to rise to about $50 per ounce. But it gets more interesting. Some analysts expect the ratio to compress even further. Silver has a dual identity that gold doesn't have. It's both a precious metal and an industrial commodity. This creates unique demand drivers that don't affect gold the same way. According to industry forecasts, global industrial silver demand is expected to achieve record levels. Here's why. Solar panels. Each solar installation requires significant amounts of silver. As renewable energy targets accelerate globally, this demand continues growing. Electric vehicles. Every EV needs silver for electrical systems and components. As EV production ramps up, so does silver demand. Electronics and AI infrastructure. The expansion of 5G networks and AI data centers requires silver. This creates steady structural demand. Meanwhile, silver mining production has remained relatively stagnant. According to research from Heraeus Precious Metals, this supply-demand imbalance is creating significant tightness in the market. Silver is often called poor man's gold, but that's actually becoming an advantage for wealth building. Jennifer Ramirez, commodities director at Global Resource Capital, explains that silver behaves like gold on steroids during periods of financial uncertainty. While gold might rise 20% during economic turbulence, silver frequently surges 40-60% during the same periods. This volatility, once viewed as a drawback, is increasingly seen as an advantage by sophisticated investors who understand how to position themselves properly. For portfolio allocation, many experts recommend a 70-30 or 60-40 gold to silver ratio. So, if you're allocating $10,000 to precious metals, that might be $7,000 in gold and $3,000 in silver, or $6,000 in gold and $4,000 in silver. Here's something that should grab your attention. Central banks worldwide are buying gold at levels we haven't seen in decades, and this trend is accelerating into 2026. According to JP Morgan Research, central banks purchased over 1,000 tons of gold annually for 3 consecutive years. For 2025, the forecast is around 900 tons, and this structural trend of higher central bank buying is expected to continue through 2026. Why does this matter? Because central banks don't make speculative bets. They're making strategic, long-term decisions about reserve holdings. What's driving this? One word: de-dollarization. Data from the International Monetary Fund shows that while the US dollar still accounts for approximately 57.8% of global reserve holdings, this represents a steady decline. Central banks are diversifying away from dollar holdings. Gregory Shearer, head of base and precious metal strategy at JP Morgan, notes that diversification away from US dollar reserve holdings, while still moderate, has been accelerating in recent years. Economic, trade, and policy uncertainty, combined with shifting geopolitical alliances, are driving further diversification into gold. For the first time since 1996, foreign central banks now hold more gold than U.S. treasuries as a percentage of their foreign reserves. Let that sink in. That's a fundamental shift in how nations view wealth preservation. When central banks are consistent buyers, it creates a price floor. They're not selling, they're accumulating. The structural demand doesn't disappear based on short-term market movements. Nolan Mock, investment research analyst at Orion, points out that foreign central banks' appetites for gold remain robust. These banks have more than doubled their purchasing activity in the past 3 years compared to the prior decade. For individual investors, this trend provides confidence. You're essentially investing alongside some of the world's largest and most conservative financial institutions. Let's talk about where experts see prices heading in 2026. Remember, these are forecasts based on current trends, not guarantees, but they give us a framework for thinking about the market. For gold, JP Morgan Research expects prices to average $3,175 per ounce by Q4 2025 and climb toward $4,000 by mid-2026. Some analysts, like those at VanEck, suggest that structural trends could potentially push gold toward $5,000 per ounce by 2030, as demand and economic uncertainty continue to grow. Peter Bookvar, Chief Investment Officer at OnePoint BFG, remains bullish on gold despite its strong 2025 performance. He sees robust central bank buying continuing and significant pent-up demand from Western investors who have been underweight precious metals. Silver forecasts for 2026 show significant potential. Heraeus Precious Metals expects a trading range of $43 to $62 per ounce for silver in 2026. Peter Krauth of Silver Stock Investor describes silver's move from under $30 in January 2025 to over $60 by December as speaking to the tightness in the market. With physical silver flowing from London to New York, ETF inflows picking up, and private investors increasingly entering the market, supply constraints are becoming more visible. As a high beta variant of gold, silver is likely to react particularly strongly to movements in gold prices and changes in the macroeconomic environment. This means both higher potential returns and higher volatility. What will drive precious metals in 2026? Several factors. First, Federal Reserve policy. Expected rate cuts in 2026 typically benefit precious metals since they don't earn interest anyway. Lower rates make the opportunity cost of holding metals less significant. Second, inflation concerns. Even as official inflation numbers have moderated, many investors worry about long-term purchasing power. Henry Yoshida, CFP and co-founder of Rocket Dollar, notes that gold and silver will play a strategic role in portfolios before 2026, especially with elevated global debt levels and continued inflation pressures. Third, geopolitical tensions. Michael Firestone, partner at Fire Capital Management, observes that heightened global tensions lead investors to feel uneasy and move capital into perceived, safer, more stable assets. We've only seen surges like 2025's before major historical crises. Fourth, the return of Western investment demand. After several years of ETF outflows, Western investment demand for gold returned decisively in 2025, with inflows strengthening month over month. Gold ETF holdings remain well below previous peaks, suggesting investor engagement has room to normalize. If you're convinced that precious metals deserve a place in your portfolio, here's how to approach it. Step 1, calculate your investable assets. Remember, this doesn't include your primary residence or business equity. It's your liquid assets available for investment. Step 2, decide on your target allocation based on your age, risk tolerance, and financial goals. As we discussed, 10-15% is the sweet spot for most investors, though 5-25% is the broader range. Step 3, choose your allocation split between gold and silver. Most experts suggest 60-40 to 70-30 gold to silver ratio. Step 4, decide on your investment vehicles. Physical bullion, coins and bars for direct ownership, gold and silver IRAs for tax-advantaged retirement investing, ETFs for liquidity and ease of trading, mining stocks for leverage to metal prices but with operational risks, Step 5. Implement dollar cost averaging. Don't try to time the market perfectly. Spread your purchases over several months to average out price fluctuations. One important note, precious metals have unique tax treatment. Physical gold and silver are typically taxed as collectibles at a 28% maximum rate when sold at a profit, rather than the lower capital gains rates for stocks. This is why many investors prefer gold IRAs or retirement-focused precious metals accounts, where the metals grow tax-deferred and you only pay taxes on withdrawal at your ordinary income rate in retirement. Always consult with a tax professional about your specific situation before making large precious metals purchases. If you're buying physical metals, storage is crucial. Options include home safe for smaller amounts with proper insurance, bank safety, deposit box, professional vault storage services, allocated storage through dealers. Each has pros and cons regarding accessibility, cost, and security. Many serious investors use a combination approach. As we head into 2026, the case for precious metals in a diversified portfolio appears stronger than many people realize. The wealthy aren't loading up on gold and silver to get rich quick. They're using it as a strategic wealth preservation tool. The 5 to 15% allocation range, with most experts recommending 10 to 15%, represents a balanced approach. It's enough to provide meaningful protection without over-concentrating in a single asset class. Whether you start with 5% or work toward 15%, the key is to begin. Gold and silver have preserved wealth for thousands of years through every type of economic crisis. That track record speaks for itself. Critical disclaimer. But I need to be crystal clear about something. This video is purely educational. I am not a financial advisor, and nothing I've said should be taken as personalized investment advice. Precious metals investing involves risks, including potential loss of principal. Past performance, including the impressive gains we saw in 2025, does not guarantee future results. The forecasts and price targets I mentioned are analyst opinions, not certainties. Before making any investment decisions about precious metals or anything else, you must consult with a licensed financial advisor who knows your complete financial situation. Consider your individual risk tolerance and investment timeline. Do your own thorough research. Understand the tax implications for your specific situation. Only invest money you can afford to have tied up for the long term. This video is based on research and market analysis current as of December 2025. Markets change, and so do circumstances. If you found this educational content valuable, please like this video and subscribe to the channel. Drop a comment below with your thoughts. Do you currently hold any precious metals? What allocation do you think makes sense for your situation? Remember, knowledge is power, but only when combined with prudent action and professional advice. Here's to your financial education and success in 2026 and beyond. Thank you for watching. Stay educated, stay informed, and always make decisions based on sound research and professional guidance.